Hi everybody, this is Chuck Gibson from Financial Perspectives with my monthly market recap for July 2015. I hope everyone is well and enjoying their summer. Damn, July's in the books already, and here we are starting August. I don't know about you, but this year is just flying by for me. In this month's video, I wanted to switch things up a bit and spend a good amount of time just looking at the S&P 500. Once that's complete, we'll take a quick look at a couple of world stock indexes, and then a new addition to portfolios, healthcare. I'll follow that up with U.S. bonds, and then as a learning tool, I wanted to revisit and check in on a couple of last month's chart. To continue with the changing things up theme, I'll wrap this up with an intro into sentiment. As always, I have too many charts and too little time, so let's get started. It's been a frustrating 7 to 8 months for U.S. stockholders, so I want to spend some extra time on the S&P 500 to show you what's been going on. The first chart here is a monthly look at the S&P since the bottom in 2009. I rarely use monthly charts here as they are too slow for our investment process, but what they are is they're really great for filtering out all the noise and present a nice clean look at a trend. It should be obvious from the chart that we have been and continue to be in a very nice uptrend since the 2009 bottom. Notice how we have not broken the purple 1-year moving average since the 2009 correction. Moving to a shorter weekly chart, you can see the same thing you did in the monthly, except the additional resolution allows us to see as we approach the start of this year, the strength of the move up began to wane. This is a good time to remind everyone that the markets do one of two things. They either trend or they consolidate. And trends can take two forms, either up or down. Like trends, consolidations can take one of two forms. They either go sideways or they go downward. What a good example of a downward consolidation is the red highlighted box in 2012. An example of a sideways consolidation is in the highlighted green box that happened in 2014. The other thing to remember about consolidations is that under most circumstances, you will see one develop before the start of a new trend in the opposite direction, meaning they occur before a trend reversal. While you give the benefit of the doubt that once they complete, they will move in the direction of the underlying trend, but that is not always the case. As such, consolidations are critical areas to watch. While we won't know until after it has completed, the current area I have framed with the two red horizontal lines starting in November of last year looks like a long, protracted consolidation when compared to any of the others in the 7-year uptrend. In fact, it will mark the longest. Moving to a daily chart of the same S&P 500 provides a lot more information and allows us to see under the hood of the weekly chart. Since the start of the year, which I have highlighted in green, you can see we are up just under 1%, and we have been bouncing within a tight 6.75% range from top to bottom. Looking even more recently within the blue highlighted area since February, we are down negligibly and have been within even tighter 4.4% range. This is a great example of a choppy, trendless environment. There has been no way to make money unless you're an active investor moving frequently in and out. Chop is very frustrating for both bulls and bears alike. Something to keep in mind is that sideways consolidations build energy as they chop around, and once they break, they typically break very hard and strong. You just don't know which way they're going to break. While I need to give the benefit of the doubt to the current trend as we continue to hold above the 200-day moving average, I do know we have not had a more than 20% correction since the 2011, and we are overdue. As such, I wait patiently, looking for the market to tell me which way it's going to go, not trying to predict. I found out the hard way positioning yourself before a big move actually happens can have very dire consequences to a portfolio if you're on the wrong side of the move. The next chart of EFA, which is the world developed markets, not including the United States, has not really changed much from last month. Like the US, EFA is stuck in an area of consolidation and is above their 200-day moving average. The most constructive thing I can say about it is that we may be in the middle of forming the handle of a bullish cup and handle pattern. If so, and to keep the pattern valid, we need to get moving higher right here, right now. If the pattern plays out, it projects to a nice 22% move higher from here. My next chart is that of the emerging markets. There is absolutely nothing new here, nor has there been for more than 5 years. The only reason why I wanted to show this chart is to give you some perspective. U.S. stock market investors have been frustrated with a choppy, trendless 8 months. Be thankful you're not invested in the emerging markets. This chart should also warn you of what could be. No one knows what lay ahead, and we too may be in store for this type of market. If you don't think we can't, take a look at the period from 1969 to 1981, and you will see the U.S. market went nowhere for almost 12 years. While the overall U.S. stock market has been relatively flat, you definitely can't say that for healthcare, as you can see in my next chart. It has risen about 14% during that same time, and has been in a very steep uptrend since the last big correction in 2011. There is no question that it has been one of, if not the strongest sector. And because we sold off some other investments that begun to trend down, we used those proceeds to add XLV into portfolios. Some may be wondering why it took so long. The fact is, we had similar exposure with our biotech IBB holding. But as the market continues to change and we are finding fewer and fewer opportunities that meet our screening requirements, sometimes we are forced to be less diversified than we would like, concentrating on those things that are trending. The next chart is that of the 20-year U.S. Treasury Bond ETF, TLT. As you can see, after forming an overbought divergent high, it began a downward correction and found support at around $115. Since bouncing off there, it has begun to move higher and closed out the month at just below an important resistance line at 122.5. With the Fed promising to raise rates, one would think that this is likely a short-term counter-trend breather and expect to see prices continue fall further, which of course may be true. But something to ponder before I move on to my next chart is what happens if the Fed doesn't actually raise rates, or maybe just raise them 0.25% for posterity's sake and then stop. Sort of a one and done type scenario. If that were to occur, we would likely see a strong rally in the long bond since its first rate increase is already baked into the price. If this were to occur, this is something I would love for clients to participate in. Until then, we'll just continue to watch and wait for an opportunity here. In the next chart, I just wanted to quickly revisit 3 from last month: silver, oil, and wheat. You probably have it memorized from my continual reminders that I don't believe anyone can predict the future. But yet, you could construe that is exactly what I'm doing when I attempt to read a chart and present either a bullish or bearish outcome. The difference is, I don't predict, but rather present the outcome with the highest probability. In fact, when it comes to investing, based upon chart reading, I always assume I'm wrong, so that before we invest in anything, we have a price where we will need to exit in case we're wrong. In the first chart of silver, you may remember I stated I expected that prices would break down below the support and fall down to around $12. Updating the chart, you can see what did in fact happen was price did break down below support and began falling. Not enough time has passed yet to see where ultimately will find its final resting point, but we are clearly on our way to lower prices. So far, so good. Let's call that a win and say I'm 1 for 1. Now, let's take a look at the oil chart. If you listened to the talking heads last month, most were stating the bottom was in and it was time to go long oil. My view was contrarian, as the charts said once we ended that sideways consolidation, we would likely have more downside. As you can see in the oil chart, it has fallen some 30% from the top of that channel, validating my downside interpretation. Hey, that makes me 2 for 2 and I'm on a roll. Let's close this out with a chart of wheat. I couldn't have timed my call for higher prices more incorrect. I think the day after I did my chart, price began to consolidate and then broke down, falling back to prior lows, losing almost 18%. So, all in all, it turned out I was 2 for 3. I should be happy because I got 2 right. Actually, I'm not happy with the 2 right ones, but rather because I got 1 wrong. The fact is, I learned little from being right and mostly from being wrong. While I did not add wheat to clients' accounts, I did invest in it personally. What makes me happy is my process identified an opportunity, I invested in an objective point, and the market proved me wrong. So what? No harm, no foul. Because I follow my process, I sold the position after it crossed the point at which I identified I would be wrong and got out with a small loss. That is exactly the way it's supposed to work. That makes me happy. As a side note, I personally invested in my other two examples of silver and oil, going short on both, and I'm still holding those positions. So far, I'm up more than 20% on both. This is trend following in a nutshell. Let your winners run and cut your losers short. The gains on the winners overshadow your small losses on the losers. What makes it so attractive is that over the long run, you have the ability to avoid major bear markets, thereby substantially outperforming a buy and hold strategy. To me, the most interesting part of technical analysis is learning about and understanding human behavior in investing. In fact, the entire science of technical analysis is really about one thing: human behavior. Why you can look at a chart, regardless of what it is, and have a high probability of understanding where it is likely headed is solely because charts reflect human decisions. Those patterns keep repeating, and they have been for centuries, and they will continue to as long as humans control markets. There's so much interesting stuff available, but in order to keep this short, I thought I'd introduce you to a sentiment indicator I follow. If I get positive feedback, I'd be more than happy to continue to include other elements of behavioral investing in future videos. It has been shown that investors during market extremes do exactly the opposite of what they should. The reason why is our emotional reaction to strongly falling or rising markets. Investors fear missing out when the markets rise and fear losing money when they fall. It's these fears that drive us to make dumb decisions. As long as there are humans with emotions, the markets will repeat, and understanding them can provide an investment edge. Warren Buffett got it right when he said, be fearful when others are greedy, and greedy when others are fearful, as he knows that human emotions are usually driving us to do just the opposite of what we should be. So, as smart investors, we want to dig further and find out how we can use this to our advantage. AAII, which is the American Association of Individual Investors, does a weekly survey polling the investing public, asking whether they are bullish, bearish, or neutral in the markets. As you would expect, the highest bearish sentiment is usually associated with the best future investing opportunities, and the highest bullish sentiment provides you a good time to reduce exposure. Is it always correct? No. And there are a lot of noise in the data, so what needs to be focused on are those areas of extreme, as the crowd is almost always wrong. If this is still confusing or counterintuitive, think of it this way. If we are at such bullish extremes and everybody's buying stocks, who's left to buy? No one. So there's only one way for the market to go, and that's down. The opposite, of course, is true. Knowing this, and before I show you the current bullish sentiment chart, try and guess where this index might be today. Would you expect that because we are within a whisker of all-time highs, bullish sentiment is at an extremely high level, indicating we're ready for a correction? Or is the investing public overwhelmingly bearish, indicating this bull is nowhere close to being done? Or maybe we're not at an extreme at all, and just somewhere in between the highs and the lows. What you guess? Well, here's the chart. This one actually fooled me, as this was one of the least of the three I would have picked. As it says, the last two times we were at this low of a bullish sentiment were near the 2003 and 2009 bottoms. I didn't expect that. We know from history that these times turned out to be one heck of a buying opportunity for those who had control of their emotions and were able to invest. The question is, will history repeat? Well, that's it. Let's call it a wrap. As always, I appreciate your time and attention, and I hope you found this video informative and helpful. If you have any special requests for the next installment or any comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the July Monthly Market Recap.